I'm Ed Rigby. I'm a tax strategist with the Kirchen Group. Our firm specializes in giving good, sound tax advice to private business owners. Private business owners typically use what's called pass-through entities for their businesses. Pass-through entities are S corporations and partnerships, and also limited liability companies that are taxed as partnerships. In this series, we've been going through key tax planning issues for pass-throughs, structuring new business ventures, looking at eligibility rules. So for S corporations, only certain persons can be shareholders in an S corporation. Also looking to structure sales of pass-through entities or acquisitions of pass-through entities. Today's segment on tax planning is going to cover the loss limitation rules for pass-throughs. The loss limitation rules are significant because if a loss is being allocated to the owners from the pass-through entity, there's a number of criteria that must be met in order for that loss to be deducted on the personal tax returns of the owners. The IRS has specific ordering rules for these loss limitation rules. The first is the basis limitation rules. So a shareholder in an S corporation or a partner in a partnership has to have basis in their equity. If a loss passes through that exceeds the basis amount, the loss isn't lost forever, but what happens is it suspends and carries forward into subsequent tax years. And when basis increases, either through a capital contribution or an increase in, or I should say, net income that's allocated in a subsequent year, that would increase the basis. Partnerships have a unique set of rules for basis. And we're going to talk about allocation of liabilities in the partnership context. Allocation of liabilities to a partner gives a basis increase. The second tier of the loss limitation rules is what's called the at-risk limitations. These rules often get overlooked. The partner in a partnership or S corporation shareholder, yes, they can have basis in their equity. However, if they flunk the at-risk rules, then those losses cannot be deductible on their personal returns until they have at-risk basis. Thirdly, we have what's called the passive activity loss rules, meaning that a taxpayer has to materially participate in that business, generally a 500-hour test per year, in order to treat the activity as non-passive. A loss to the extent that there's basis, there's at-risk amount, and if that loss is not subject to the passive loss rules, then that deduction can be taken on the personal return. What happens if it's a passive activity? Well, if it's a passive activity loss, the owner can only deduct that passive loss to the extent of other sources of passive income. It could be from other activities that are passive, or it could be in a subsequent tax year when passive income is generated, or when the activity is sold in a fully taxable transaction. There's special rules with respect to the passive loss rules for real estate professionals, and those rules have been in place for a number of years, generally allowing rental real estate activities to be treated as non-passive for those that qualify as a real estate professional. So let's get into the basis limitation rules. Let's talk about partnership liabilities. If a partnership goes out and borrows money from a bank, let's say, and allocates those liabilities on the K-1 to the partner gets an increase in basis, as I said. What's different in an S corporation context, the S corporation goes out and borrows money from a bank. The shareholder in the S corporation does not get a basis increase for the debts of the entity. It's only if the shareholder makes a true economic outlay, meaning that they either loan money into the S corporation or they contribute cash or other property into the S corp. But with partnerships, there's a basis increase for the partner's share of liabilities. There's also a decrease in liabilities results in a deemed cash distribution. So sometimes we worry about phantom income. When liabilities are reduced, it means that the partnership has actually made a constructive cash distribution out to the partners. Now, in the partnership context, there's an important distinction between what is recourse debt and what is non-recourse debt. And there's a highly set of complicated rules that the IRS has in their regulations. Recourse debt essentially means that a partner is economically responsible for the debts of that partnership. The IRS has said to me that, Ed, show us in the loan documents that that partner is signing as a guarantor on that debt, or if the partnership were to liquidate itself, that partner must step forward and make the payments to service the debt. That's recourse debt. There's an economic risk of loss. The distinction is that recourse liabilities then would generally not only give basis to the partner in their partnership interest, but also give them at-risk basis to deduct losses. There's a distinction between what is recourse debt and what is non-recourse debt. Let's talk about non-recourse debt. Partnership goes out and borrows money from a bank. There's no partner that's individually responsible for the payment of that liability upon default of the partnership. If the partnership defaults on the payment, the only recourse for the bank or the lender is to foreclose on that property. So the property serves as collateral or security for those loans. True, there's an allocation of the liabilities to the partner. It gives that partner basis, but what it does not do is give them at-risk basis. So for non-recourse liabilities, there's a complex set of allocation rules. There's a three-tier mechanism. Essentially, the IRS says that you allocate non-recourse debt to the partners based on how gain would be allocated to the partners associated with those liabilities. What's important, though, what I'd like you to come away with here is that there is an important distinction between recourse and non-recourse liabilities. We see it all the time. The IRS would love to get into those partnership returns, look at your K-1, and if they can prove that if an allocation of liabilities was improperly treated as recourse, meaning that the partner is economically responsible for the debt to be repaid, either through a guarantee or if the partnership defaulted, that they would have to step in and make that payment. Or if the IRS can prove that it's non-recourse, then you have an at-risk limitation problem. And this happens, it's quite common. So with non-recourse liabilities, and in the tax code, there's always nuances, there's always exceptions. There's an exception for real estate ventures, and it's called qualified non-recourse indebtedness. If you look at the K-1 document, you're going to see recourse liabilities, non-recourse liabilities, and qualified non-recourse liabilities. Ed, what's the distinction? Well, a qualified non-recourse liability, the partnership borrows money from a bank, the partnership goes out and buys real estate, commercial real estate. The debt is secured by the underlying real estate that's used in the real estate venture. There's a special rule that's carved out, even though it's non-recourse debt, qualified non-recourse indebtedness actually gives the partner at-risk basis. Going back to S corporations, again, the important point is, and I see this a lot when talking to clients, there's the debts of the S corporation do not give a basis increase to the shareholder. It's only if the shareholder makes an economic outlay, meaning they put cash or loan cash into the business, or make a contribution of property into the business. Economic outlay gives them basis, gives them at risk. So those are a complicated set of rules. I think what I'd like you to take away from this discussion is that understanding the distinction between partnership taxation and S-corps, that a partner true gets an allocation of liabilities, they increase their basis and their partnership interest, but you have to watch the at-risk limitation rules. That gets missed a lot. I hope you found this information useful. If you have any questions on any topics of taxation, or in particular today about the loss limitation rules, please contact us at the Kirchen Group. 732-747-0500 is our telephone number. Thank you for watching.